welcome to my presentation on lifetime mortgages, a chance of a lifetime. I'm Emma Watkins and I'm the Managing Director of Retirements and Longstanding at Scottish Widows Limited. More pertinently for this presentation, that includes bulk and individual annuities and the loan investments that back those liabilities. As an insurance company, I'm more interested in lifetime mortgages as an investor, a funder, rather than looking primarily at the product design or indeed the sales process. So my presentation will focus on that aspect of lifetime mortgages, and hopefully it's a perspective that brings some interest to yourselves. There we go. And indeed, flipping over from the title slide, I thought it would be useful to give you a little bit of background on the group structure. Scottish Widows Limited is the insurance division of Lloyds Banking Group, with Scottish Widows Bank a brand of the group, much like Halifax or Bank of Scotland. In 2020, the group launched a lifetime mortgage lending platform under the Scottish Widows Bank brand in response to the increasing later life needs faced by our banking customers. Over the course of last year, they launched the core lifetime mortgage products and progressed a rollout to the major brokers and advisors, ensuring delivery in what I think we all recognise as being a particularly challenging year. So, turning to the customer need, or in other words, the pension squeeze and the need for lifetime mortgages. We've seen a shift from defined benefit to defined contribution. We're starting to see far less pension being paid by those defined benefit pension schemes, with defined contribution pots still being relatively small. Indeed, our research showed that about 45% of people have not adequately provisioned to enjoy their retirement. I think it's fair to say we all want to enjoy our retirement. So clearly, an alternative source of income is the wealth trapped in housing, and that's currently standing at £1.5 trillion for those aged over 55. Now, given we know the majority of customers want to keep living in their house, lifetime mortgages could be a very appealing product to many. Indeed, most people think property should form part of holistic retirement advice. And as you know better than most, a lifetime mortgage allows a customer to release capital without downsizing, which may be both emotionally traumatic and expensive, but clearly should be considered as an alternative nonetheless. Another angle to this, which I will feature on as we go through the presentation, is that given the majority of borrowers want to use the money to look after their property, the industry may be able to provide incentives for them to make those improvements in an environmentally friendly and sustainable way. In summary, there is a genuine need for well-designed lifetime mortgage products which are sold appropriately. Outcome of the customer insight that we carried out under Scottish Widows Bank was that the products need to be designed around two main needs. So the first one is it needs to be transparent and easy to understand. So by way of example, our products offer fixed early redemption charges as opposed to those based on gilts rates, for example. The second ask is that they need to flex with customer needs. We offer drawdown features and other flexible options, but as we'll come on to, there are challenges from the funder's perspective to providing this flexibility. Is the attraction to insurers as funders of lifetime mortgage market? Probably worth just focusing on the bulk annuity market for a second. So the average duration of liabilities coming to the bulk annuity market is increasing. So we're seeing an increasing duration, i.e. the individuals coming to be insured are younger. And that's predominantly as schemes are better funded, closer to their end game, more trustees are looking to insure the whole pension population rather than, say, just their pensioners. So as a consequence of that, there's an increasing need for longer duration assets to match them. Lifetime mortgages are a great product in this respect, right? They satisfy the need for equity release for the customer, and they provide long duration assets for annuity insurers such as us, and to a lesser extent to pension scheme investors. Insurers, however, need to have fixed and certain cash flows under the Solvency II regulations, which is a European directive, which means that we have to structure portfolios of lifetime mortgages in a relatively complex way in order to deliver fixed cash flows and thereby limiting longevity and no negative equity guarantee risks. But as a result of that complex structuring, a proportion of the cash flows is effectively excluded from our investment assumptions as a result. Now, regardless of these challenges, the vast majority of lifetime mortgages are financed by insurers, which shows that it's still a very attractive asset to them. So, what are the challenges and opportunities of bringing the customer and the funder perspectives together? The interests of advisors are completely aligned with borrowers in ensuring that borrowers and their families fully understand the product and the alternatives. Holistic advice, which considers the full width of the borrower's circumstances and a wide range of solutions, is likely to achieve a much better borrower outcome. Borrower circumstances may also change over the long duration of a lifetime mortgage. And therefore, we need to think as an industry about the advisory journey over that longer period, not just at origination. Product complexity. Whilst we have a desire to provide product flexibility as insurance investors, as I mentioned before, our regulatory requirements mean that certain product features will come at an increased cost, such as fixed early redemption charges versus their gilts or index-linked related charge, or indeed flexibility around the timing of product drawdown, etc. Now, in a post-Brexit world, there may be an opportunity to amend the regulation in a way that reduces these costs. And indeed, HM Treasury are already asking for feedback on how it might review Solvency II. So there's certainly some potential good news coming down the line in that regard. Property. It is just more difficult to underwrite loans based on the value of property versus regular mortgages. Two main reasons for this. One, there's no recent purchase history typically. And two, we're ultimately dependent for repayment on the property value in some 20 to 30 years' time. Now, with a normal mortgage, the dependency is more on the affordability of repayment. And it's very likely any normal mortgage will be refinanced on a fairly regular basis. So whilst the very long duration of lifetime mortgages is a key appeal for annuity investors, it does mean that we need to carefully consider both climate risk and sustainability, which I'll cover on the next couple of slides. Finally, ongoing monitoring of the properties will be a requirement, but it has to be done on a non-invasive, collaborative basis with a clearly defined contact strategy. Longer term, it's going to help both parties to maximise comfort of occupancy and the value of the product, the property. And it may assist in identifying borrowers who have fallen into vulnerable circumstances and require additional help. So now turning to climate risk. Climate change creates physical and transitional risks for the mortgage sector more generally. Two main risks, physical risk and transition risk. I thought I would try and give you an example of both to bring to life what those are. So, a prominent physical risk is flooding. Just under 9% of current mortgage properties are at risk of flooding, and in a reasonably extreme, but not impossible scenario of a 4-degree increase in temperature, that 9% increases by a further 40%. 40% more UK properties could be at significant risk of flood by 2050. Turning now to transition risk, emissions are a really good example of transition risk. I certainly didn't believe this to begin with, but it's really interesting to note that the residential sector is responsible for some 15% of all UK greenhouse gas emissions. The sector must significantly reduce its carbon footprint to meet the government's target of achieving net zero emission by 2050. However, forecasts still suggest increasing emissions from this sector well into 2030. So, regulation may well drive behaviour. It's already started within the private retail sector, and it may well spill over into the owner-occupied segment. For example, we may require energy-efficient home retrofits or indeed heat source changes. As investors, we are obviously concerned with the potential for properties to become more susceptible to flood risk or other weather-related risks that change or increase as climate change progresses. But this is a really complex and evolving aspect of property underwriting, given how far in the future we need to look. We're also concerned with transition risk. There is clearly a potential for properties that are not maintained or updated to not increase in line with the wider market, increasing our neg risk. So, turning now to think specifically about the lifetime mortgage market, I think it's important to note that this market is particularly exposed to climate and sustainability issues, as it tends to be secured on older housing stock, which may not reflect the latest technology or indeed standards. There are potentially some really interesting opportunities in product design here, whereby borrowers who can evidence property improvements and perhaps strong EPC ratings could be rewarded with lower interest rates. And we are aware of one or two providers already offering that. It is definitely an opportunity for the future and a win-win for both funder and customer. As an industry, we need to continue improving the advice journey, both at origination, but perhaps more importantly, over the life of the product. We need to consider if Brexit creates opportunities for regulatory change that ultimately allow further enhancements in product design and pricing without that increase in cost. And we need to address the challenges of climate change and look at the potential for further product innovation and indeed incentives to take that further. I'd like to thank you very much for listening. I do hope you found that perspective helpful, but slightly different to some of the talks that you may be listening to today. And with that, I'll sign off. Thank you.